In our previous video, we talked about the put-call ratio and how it was signaling to us that we should start to be cautious in the S&P 500. That video was at this candle right here. The next 2 days have been down moves in which we've made a move back down to the high of the swing high to swing low, which is what gave us that 1272 extension. In this video, let's do a recap to see what the put-call ratio currently is and see what kind of clues we can gather to see if there's more downside left or if we have room to start bouncing from here. Okay, so here we have our utility labels plotted, and our put-call ratio is still at a 0.71, and this is the moving average of the put-call ratio, but that still is plotted as a red chart label, letting us know that we should still be cautious. Now, if we take a look down the line, what we should notice is the transports. The transports went from being bearish back to neutral. So now if we take a look at the transports, what we can see is it's really been trading inside of this range right here, right? Now we do have 3 edge arrow signals populating, which gives us a slight bullish bias where you could start to look at the S&P really having more of a bias towards bouncing from here instead of continuing to fall down to say the 50% retracement or anywhere in between. So that's one way that you could start to gauge whether or not the S&P is going to break one way or the other. It's using the transports as your proxy, right? Another way that we can take a look at it is if we look at our standard deviations, we can see that we've come back down to the 2 standard deviation line, which would make sense to start to bounce from the 2 standard deviation line back towards the 3 if we are looking for a bounce. However, because our put-call ratio is still signaling to us to be cautious, there is still that likelihood that we can continue to make this move down lower. And if we load up, say, our moving averages here, we can load in 4 different moving averages. And if we say bring in the 8, and then we can have, say, the 21 here, and we'll make this a purple color. And then we can say bring in the 34, and we can make the 34 yellow. And let's just get rid of this last one for the time being. And if we click apply, we can see that on the overall scale, the S&P has pulled back to what is that 21 period moving average. And this is where we would be looking at a potential likely reversal point. Now, one more way that we can do some analysis is using a potential retracement move, right? And so if we draw the same retracement from this swing high to this swing low, and we see where that lines up, we see that that swing high to swing low would line up perfectly with our 50% retracement. And previously, when we did correct, we didn't stop at just a 21 period moving average, but we instead came down to the 34 before starting to bounce up higher, right? And for our members, that edge signal is really that final confirmation signal, which gave you the confidence to start to look at a potentially bullish move. So that is the plan of action that I'd be having. It's to look at that sideways chop in the transports and start to use that as potential clues. Now, the bias on the transports is bullish using the edge signals. However, we can also see how there's these nice confluences of levels where it wouldn't be too surprising if we continue to fall back down to that 32.75 area. So I think the levels that you could be looking at are 32.75 if we do continue to fall back down lower. And if we are starting to make a move back higher, then our next target is that 1618, which is 3414.60. All right, so if you're playing this move with options, give yourself the gift of time and allow yourself to be wrong if we are looking for a deeper pullback and you're looking to start to scale into this position. And for options players, you may be looking at a potential butterfly hedge if you're looking for a move back to that 50% retracement, and this time on the SPY. So you can use the SPY options. On the SPY, that 50% level lines up right near that 327 zone, 326.84, which leads you to the 327 strike on the options chain. And if we draw a time series as well between this swing high and this swing low, and we measure that from this swing high, and that low comes in right around February 29th, 20. So you'd want to get options that are at least outside of February 29th, 20, and the March monthly seem to make the most sense. So if we look at a potential butterfly example, that could be something like the 327s with wings at 320 and 334, so $7 wide, which gives you a risk of right around 70 cents. So that's the debit paid, and your max potential gain with a pin right near that 327 zone is 625-ish or so. Now, obviously, you wouldn't get that full profit potential that we're looking at, but even if you're able to capture a good percentage of this, that's a way that you can participate in this downward move in a way where you've structured your risk. You can take as many contracts in increments of 70 cents as possible, and you now have a relatively low risk way of protecting yourself from a down move, especially if you are looking to get into the bullish side early. All right, hope this video helps, and we'll see you all in the next update. Take care, everyone.